Welcome to This Week in Money. I'm Jim Goddard. Today, CIBC Wood Gundy's Ross Clark will run down the latest from the major equity markets. InsideTrack.com President Eric Hadik looks ahead to what's likely to happen when you take into account 17 and 40-year cycles that have affected economic factors for hundreds of years. He explains how he became fascinated with the cycles and how accurate they've been even before we knew the scientific reasons behind them. We'll talk to Ross Clark right after this.
I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark. He's an investment advisor at CIBC Wood Gundy in Vancouver. Welcome back to This Week in Money, Ross.
Always enjoy it.
Well, the Dow hit a record high. The Toronto Stock Exchange in record high territory. What's going on there, and can we expect these highs to continue?
Well, it's been just an excellent run, depending upon whether you're measuring from the U.S. election day or you're measuring from some minor pullbacks in December. And I'm a historian. I love to take a look back, and there's really not a lot new under the sun. From my perspective, looking at the post-election period, the market was already in an uptrend. We talked about how the rally should take us to the middle of February as a normal window, so we're up where we should be. And if we take a look at the years such as this, where you had a first-term president, the movement, this 13 to 15% rally that we've had, is the single most common item. There's 3 out of the 6 instances that actually are 15% runs into February. One of them is 12, and then the 1929 one just blows it out of the ballpark. That was a 22% move after the election, but it had a really, really hard break going into it. So that's more of an anomaly. So, so we've got the normal type of movement to the upside, this 15%. We're starting to see excesses. If we look at any of our indicators, the relative strength indicators, anything that's momentum-based, they're all really getting up to their extremes. And we tailed off at the end of the week just with a flat day or two, and it looks as though we're setting up now for a pause in this move. And another thing that would suggest that is that when we look at the option premiums and we look at the VIX, which measures the amount of premium that's being paid, the VIX itself is exceptionally low. It's been down in the 11 to 12 range for the last couple of weeks, but it's made a marginally higher low than it put in January. And the longer-term VIX positions, which is the VXZ, and I don't want to get too complicated here, but when the nearby VIX puts in a higher low and the one that's out in that 4 to 7 month period is putting in a lower low, invariably the market has staged a minor correction, usually back to its 50-day moving average. And in our instances right now, that would be about a 3% move off the high. And that fits in perfectly with the type of action that you would see following a mid-February high in this first year of the president.
So if we do see a small drop in the market, that doesn't mean it's crashing.
No. Actually, what we want to be looking for is a correction that maybe has 2 minor waves of selling within it. Takes the better part of maybe 10 days to 3 weeks, takes us into March. And ideally, if we just have a 3 to 7% correction and start to find support, and that should also be above the lows that we saw in that first week of January, because we had a bit of a pause in December, and it was early January we came back to life. So the lows that we put in right at the beginning of January, if If we can hold those levels, then you should get another good bump into April, May. And that would finish off the normal seasonally strong period, which is that end of November through the first week or so of May. I mean, that's what we see historically. The most positive bias to the market is inside that time window. When you get through the summer months, it's not so much that you always fall in price, but you tend to get many more downside moves during that period because it seems to be less of the positive news that comes around.
If it's more than a 7% correction, would it be panic stations?
Okay, so we've got some clear numbers to be looking for on the correction. If it does break hard, you probably are looking at a worst case scenario of maybe a 12 to 15%er. That would be the norm out of the pattern that we're working with right now. I don't think you're looking at a 2008 type of scenario. It's been quite a while since we had a really good correction. There was I think it was a 12% this time last year, down for a very short period of time and then back up. Maybe that's the style that you could be thinking about.
Kind of a culling of the herd, isn't it?
Well, it is. I mean, if everybody's been built up on the Trump bandwagon, but clearly it's going to be more difficult for them to come through with a number of things such as the tax changes, because it's there's talk that the border tax may not go through, and if that doesn't, then they don't have the additional funds to help with the other cuts that they want to make. So this is probably going to be a second half of the year item rather than a first half of the year. So as things get delayed, that euphoria will disappear, and it would be normal that you would go into more of a back and filling approach in the market. So you'll have to be more stock specific rather than looking for general moves. And if you look at what's happened in this last couple of months, financials, the IT stocks, all been making just phenomenal moves. They're due for a pause, and some of the other sectors that have been under some pressure and not done anything, maybe they're better values and will come back.
Ross, thank you so much for chatting with us.
Always like to be with you, Jim.
My guest has been Ross Clark. He's an investment advisor at CIBC Wood Gundy in Vancouver. Coming up, Eric Hadik next on This Week in Money.
Always consult your investment professional before making any investment decision.
GEM International is a new diamond explorer in the richest diamond producing country in Africa, located next to the fourth largest producing diamond mine in the world. International Spotlight is on an 1109 carat diamond recently discovered in Africa by a fellow Canadian junior. With a proven operator and finance team, GEM International trades on the TSX Venture Exchange. Symbol GI. Visit us at gemdiamondmining.com.
This Week in Money is archived online at talkdigitalnetwork.com.
My guest is Eric Hadik, president of InsideTrack.com. Welcome back to the show, Eric.
Thanks for having me back, Jim. Great to be here.
Gold and gold stocks had a recent rebound, kind of flat right now. What's going on there?
Well, it fits in with the bigger term picture that I've been conveying to you the last couple years. And starting out with that overarching outlook, my work, both cyclic and technical, was looking for a major bottom in late 2015, an initial 6-month or so advance in 2016, something that would initially break the grip of the bears, but something that often normally gives way to a pretty significant sell-off as well. That's how most of your first waves are. And the outlook was for a secondary low in late 2016, and then the development of a more complex and probably more volatile advance in 2017, 2018. So I think what we've seen the last month and a half or so is certainly the first step in that 1,000-mile journey, and I think that gold and silver have given some important indications of that reinforce that a multi-month bottom is intact. Silver actually has one more confirming indicator I need to see actually on the February 17th weekly close. Needs to close above a key level to turn my weekly trend indicator positive, and that's more of a confirming lagging indicator, not a leading one. Gold has already turned that trend up. But the gold stocks have been very intriguing to me over the last couple weeks, particularly comparing some of the chart action between the XAU gold-silver index and the HUI gold bugs index. And, you know, they do have different makeup and different objectives. And so you expect some diversity between them, some divergence at times. But on a technical basis, sometimes that also gives important clues as to when intermediate tops and bottoms are poised to take hold. And that has continued to happen with those two indices and the divergence between them, both the divergence in the magnitude of their advances and sell-offs and the divergences with certain indicators that are triggered in one and not the other. All of it is giving a pretty convincing picture of what we have seen recently. And in fact, one of my weekly relay alerts last week was discussing, really elaborating on some of these competing divergences between the two indices and showing why that February 8th, 9th time frame was poised for an intermediate high and so at least a 1 to 2 week peak and ideally a 2 to 4 week peak and a decent pullback from there. And there are a lot of things that factored into that, including the magnitude of their rallies. And you look at how strong the XAU has rallied, especially when you compare it to previous levels in the decline from August through December, and then look at the HUI and see that it has not even been able to exceed the November peaks, which the XAU did some time ago. And that's one of those kind of yellow flags that starts to creep up on the charts and show, okay, there's some divergence here, there's some underlying weakness in the one index that's not in the other. And when it bumps up against specific target levels and you've got that type of divergence, it's kind of an ideal scenario for an intermediate top or bottom, and in this case a top. But there are some confirming or corroborating indicators that are also showing some underlying weakness. And so if the HUI can't get above its November highs during the month of February, it could be poised for a pretty significant pullback. But all of that, again, is part and parcel of the big picture outlook, where I thought that this first and second quarter of 2017 would be the starting phase of a new bull market. So there are some key levels that I published in this alert, and even some retracement levels where those indices could drop back to in the coming weeks that are going to be really some of the determining factors going forward from there.
Is one of the factors the Dow and the Toronto Stock Exchange both hitting record highs and maintaining it for some time?
Well, I think that has certainly added a positive factor, that if you saw that those starting to level off, and if gold and silver saw any sort of retracement in there, then all of a sudden that's one of those things where you see it a little bit more exponentially reflected in the gold and silver stocks, because even when gold and silver are kind of leveling off, if the overall equity indices are rallying, then the stock part of gold and silver stocks is benefiting. And, when gold and silver are rallying, whether or not the equity indices are moving higher, you got the precious metals aspect of that gold and silver stock benefiting it. But you have also seen, looking back over the last 10, 15 years, some serious divergence between the metal and the stocks when overall equity indices are going through some corrective phases. And I've been discussing why I thought March 2017 through March 2018 was going to be a more challenging time for overall equities. And so I think if that comes to fruition like I'm expecting, I think that's when you're going to start seeing this battle between what the metals are doing and what overall equity markets are doing. And so the gold and silver stocks seeing a lot more volatility, and that's when you have to be much more selective about your entry and exit levels and when you're looking to get in and out of them.
Is it an interesting balance between the stock price and the price of bullion when you start to see the overall stock market go down?
Yes, and that's what I'm saying. When you look at some periods of time over the last couple decades where equity markets were heading lower, then it's more of a struggle for gold and silver stocks to benefit even when gold and silver are heading higher, except for when you have those more parabolic moves in the metals prices or in the bullion prices. But when that's not the case, that's when you have, gold and silver might be trending higher and every few weeks taking out previous highs, but maybe not doing it by a huge amount. But at the same time, you'll see the gold stocks doing just the opposite. They'll rebound, but they'll set lower highs. And then what happens too is as soon as that positive influence of the bullion price is removed, even if gold and silver just kind of trade sideways for a couple weeks, if you've got the overall equity markets selling off sharply, then the gold and silver stocks will typically move in tandem with that, since they don't have the offsetting positive influence of gold and silver heading any higher. So when you look at these trends over a large period of time, and I'm talking 6, 12 months, something like that, you might see something where the gold and silver stocks trended lower on balance through that period of time, even though the metals traded higher on balance through that period of time. And the big difference is that when you had the sell-offs, they were so much more pronounced in the gold stocks, and when you had the rallies, they were more pronounced in the bullion. And so even though the moves might be happening kind of at the same time, when you step back and see what the progression is and what has been accomplished during that whole move, you realize that one trended lower and the other trended higher, even though I constantly get readers telling me, how can that be? That's impossible. But those simple, uncomplicated correlations are sometimes very dangerous because they don't take into account key factors that often create more of the synergy than the simple correlation that many traders think just has to stay a one-to-one correlated market.
We'll have more with Eric Hadik next on This Week in Money.
I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. I'm Jim Goddard. We're speaking with Eric Hadik, CEO and president of InsideTrack.com. Eric, what kind of a relationship does Russia have with the gold market?
Well, I think that is, it's multifaceted, and to really answer that question, I'd have to go back a couple years to some of the longer-term cycles and analysis that I published back in 2014. I was discussing the longer-term cycles in Russia, and in fact, one of the most uncanny that I've seen is a 40-year cycle that's kind of similar to one I've described with U.S. markets and global markets, but it's also a very consistent geopolitical cycle, and I've traced it back hundreds of years where Russia was concerned, but then really honed in on the time since America's founding, and some of the interaction, even though America wasn't involved in a lot of that interaction in the early stage, it was more Russia and Europe, but those cycles really kind of pinpointed these key watershed turning points in Russia's history, dating back to 1776 and really the period from 1775 to 1781, where Russia was in their golden age, and Russia really kind of lent some tacit support to America, the colonists, trading with America, and much of it was kind of a enemy is my friend type of thing, because they were very upset with Britain at the time after the 7 Years' War. But from that 1776 period, then you jump forward to 1816, 1817, when you had the culmination of the Napoleonic Wars, and which really stemmed from France's failed invasion of Russia in 1812, and from 1816 forward, Russia took on a very important role in Europe's politics. And then you jump forward to 1856, 40 years later, and you've got the culmination of the Crimean War, which, what is really one of the core triggers of the conflict between the U.S. and Russia and Europe and Russia right now. It's the annexing of Crimea a couple years ago. But you had a major shift in Russia's geopolitics in 1856, then in 1896 when the final Tsar was coronated, and then 40 years later was the Constitution of the Soviet Union in 1936, and started a new phase in 1937. 40 years later, you had the third and final Soviet Constitution come into play in 1977. And along with a lot of associated conflicts with Russia and Europe, and then Russia and the U.S. As we get into this last century. But all of that, when I was publishing that in 2014, was leading me to the conclusion, based on a lot of other even market analysis, that Russia would really see a big shift in 2016, 2017, that's when I thought that they would start to exert their influence more, because what my work was saying up until then, and I discussed back then cycles in the Russian ruble, cycles in crude oil, that were all calling for a kind of a crash from mid-2014 into early 2016. And so I thought that's when the Russian ruble would bottom, and that's when crude would bottom, and that's when Russia would start to kind of come back to life. There's also a very intriguing 17-year cycle that I document in the markets, and that also coincided with Vladimir Putin's 17th year cycle since taking control. And there was just a lot of other work. I sometimes focus a lot of the discussion on these bigger 40-year cycles and related things that I think maybe some listeners have trouble either grasping or accepting their credibility, but it's kind of uncanny when you see how consistent those cycles have been. And again, all of this was published back in 2014, 2015, identifying why I thought 2016, 2017 would be when Russia really started to exert their influence again, and when things started to turn positive for Russia's perspective, and why I thought that the ruble and crude would bottom in early 2016. And suddenly all those things started to come to fruition, and the entire election campaign is just starting to reveal one aspect of that influence wielding on Russia's part, and all of the latest revelations, right down to those dealing with Michael Flynn and his ultimate resignation due to speculation about what his calls with the Russian ambassador involved. But it's just reaffirming to me that these longer-term cycles are very accurate. But then you look at things like gold when we're talking about the correlation there. And, you know, in 2014, 2015, who was the biggest buyer of gold internationally? It was Russia. And what were they doing to fund a lot of those purchases? Selling U.S. treasuries. And you see China doing a similar thing, and part of the speculation is that this is a slow, steady, very methodical planning for the unseating of the U.S. dollar as the global reserve currency. And even though the dollar would still play a big role, if the dollar gets unseated as the sole reserve currency, which is already happening in many respects, but kind of once you hit that tipping point where investors and the nations of the world kind of accept that there's more of a global basket of currencies as the reserve, that's going to have a dramatic shift on an impact on the dollar and on gold, with again these primary gold holding and gold producing nations, with China and Russia being, I believe it's first and third largest producers, but also some of the largest buyers over the last few years. You kind of see that there's a base being built underneath gold and silver, and that it just takes, it's waiting for that watershed moment or event when suddenly everyone's either running for the exit doors or cramming to get into the market at the same time. That's when you see those parabolic moves, and I think from some of my chart work, some of my cycle work, it's starting to pinpoint when that time frame is most likely, and still out on the horizon a little bit. But I definitely see a very strong correlation between what's going on with Russia, what's going on with China, and what is happening sometimes out of sight or a little bit beneath the surface where gold is concerned. And I do think that there's a period of time in the coming years where that's really going to take on a much larger role, and and really impact the price of gold exponentially.
The Trudeau government sold off the last of Canada's gold reserves. Was that a mistake?
Well, that's one of the things that you see over several decades here, that Western countries often selling when other Eastern countries are doing some buying, and it's definitely a tug of war, no doubt about that. And it comes down to who's going to wield the ultimate power and influence that final decision, where fiat currencies and the dollar and the euro, how they end up comparing to gold and silver, and and then you've got your cyber currencies slowly taking on a role in that as well. So as far as what Canada has done and their rationale for that, can't tell you, but if my analysis and outlook for gold over the next few years is accurate, this wouldn't be the time where I'd want to be liquidating a bunch of gold, selling it instead of buying it. So, but often there's other more urgent factors, political factors that take precedence over everything else. So, don't know what the rationale was there.
We'll have more with Eric Hadik next on This Week in Money.
Gem International is a new diamond explorer in the richest diamond producing country in Africa, located next to the fourth largest producing diamond mine in the world. International Spotlight is on an 1109 carat diamond recently discovered in Africa by a fellow Canadian junior. With a proven operator and finance team, Gem International trades on the TSX Venture Exchange, symbol GI. Visit us at gemdiamondmining.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. I'm Jim Goddard. We're speaking with Eric Hadik, CEO and president of InsideTrack.com. So it looks like Russia and China are dumping their paper currency or paper holdings and trying to pile up their physical holding in the form of gold.
Yeah, and it's that thing that I know we've talked about it in the past too, but when I discuss the 40-year cycle with regard to currency and the battle that has gone on between fiat currency and between gold and silver throughout the entire history of America, and I document these periods where that battle is most ferocious, where it really has its strongest competing events, and they come in perfect sync with this 40-year cycle, going back to, and I've kind of identified this 8 to 9 year period, which came back into play now between 2013 and 2021. But you go back on a 40-year increment, 40-year multiples, going back to the founding of America, 1773 through 1781, and one of the big things in there was the first experiment with fiat currency, the Continentals, which basically crashed from 1775 to 1781. And then you have in 1813 through 1821 a similar battle between, basically it comes down to currency control. And you had the rechartering of the Second Bank of the U.S. And when that took hold in 1817, very soon after you had the Panic of 1819, you had an economic malaise into about 1821. And so that was exactly 40 years from the culmination of the crash in the Continentals. And then you go 40 years forward, and 1853, where all of a sudden the government started reducing the amount of silver in coins. And between 1853 and 1861, you saw first suspension of silver payment, then suspension of gold, and ultimately leading into the beginning of the Civil War, which ushered in a very inflationary phase. And 40 years later, 1893 to 1901, you had similar bubbles and crashes with gold and silver, fight over the gold standard in the election of 1896, and the reinstitution of the gold standard in 1900-1901. And then 1933 to 1941, similar events with the outlawing of gold and silver, confiscation, and ultimately leading into World War II in 1941. And then 1973 through 1981, you had the collapse of Bretton Woods, which was all about currency alignments and coordination, led to the pricing of oil in dollars, which was really the de facto dollar reserve currency of the world, was instituted at that time. 1976 was the Jamaica Agreement, which delinked almost all Western fiat currency from gold, and you saw another inflationary parabolic move from 77 through 1980. So that 40-year cycle and the specific phases of it just keep recurring like clockwork, and I thought that 2013 through early 2017 would be the initial actions, often happening beneath the surface, and then 2017 through 2021 would be when the market started to really reflect it, and we saw another inflationary surge. But you go back to that 2013 to early 2017 period, and you look at all the events that did end up transpiring, most of them with Russia and China at the foundation of them, and I'm talking about everything from the BRICS New Development Bank and the China's Asian Infrastructure Investment Bank, and then the Yuan or Shanghai Gold Fix, and most recently the Yuan being included in the IMF SDR calculation in just October of last year. All of those things are setting the stage. If you look at them and picture them as, look for the common thread through them, and look at the puzzle pieces starting to come together, they all have at least one common thread, and it has to do with that providing a competing alternative against the U.S. dollar as the reserve currency of the world. And, you know, the yuan getting included in the IMF, in the strategic reserve, drawing reserve, you know, that you kind of look ahead a little bit and you say, okay, now China wields even more influence. What's the likelihood that in the coming years they're going to start to push to make that SDR more of a global reserve currency? And I know when that was happening last year, a lot of people were just focusing, trying to make it look like the dollar was going to collapse right then. But it was actually the euro and the yen that were seeing the greatest reduction of their role and their percentage in that SDR calculation. And so they're likely to be the ones that suffer first, and then perhaps the dollar after that. But gold and gold reserves factor into that as well, and I think that is the overall scenario that is slowly playing out. And again, I thought 2017 through 2021 would be when that whole scenario starts to intensify, starts to accelerate, and you start to see more of the markets reflect it more overtly, more obviously, to where then, you know, a year or two from now, you're going to have all the pundits coming out and say, oh, well, this was easy to see back in 2013, 2014. You know, just look at this sequence of events that were happening. We should have known this, just like we should have seen the mortgage debacle coming in 2003, 2004, 2005. But the pundits are always great at doing that after the fact, whereas these cycles are very uncanny in giving you some pretty clear indications before the fact.
So using the cycles, what are we going to see happen with gold over this year?
Over this year, I think it is going to be a developing bull market, but it's not until later in this year and then in some specific time frames in the third and fourth quarter of this year and then in 2018 that I think you will see more sustained and more convincing moves up in gold. And before then, I think you have to be very careful and very agile when trading the market, unless you're just putting on positions and walking away from them for a couple of years. I think there is going to be a big struggle here as the dollar is finishing a really what's an 8 to 9 year rally, more significantly since 2014, so a 3-year rally. But as that rally is culminating and gold and silver are completing their basing process, you can expect to see a violent tug of war. And so, I'm looking at intermediate moves trying to capitalize on the 2 to 4 week swings during that time frame, but at the same time keeping in mind the underlying trends and the underlying cycles that are transitioning, and building a position in gold and silver while starting to move away from the U.S. dollar when the signals that I need to see start to, when they're triggered.
Do you know what those triggers will be, or are you just as curious as everybody else?
Oh, no, I'm speaking of very specific technical and price triggers that I need to see, some on monthly basis, some on weekly basis, and there's a sequence of signals that I look for as a larger degree trend is developing and unfolding. And we've seen the first couple of those in gold and silver, and I wouldn't be surprised to see 1 or 2 more of them triggered before the middle of 2017. So they are very specific levels, and I am talking technical and price levels. And then I expect the fundamental triggers, they usually come into play halfway through a trend. And in fact, often some of your fundamental events come to light in the final days of an initial move, which is why so many traders that are trading off of those fundamental events get so frustrated, because they suddenly jump into the market when everyone else is already in the market, and they can't understand why a day or two later the market tops and then over the next month or two sells off sharply, even though this bullish fundamental is still in place. And it has to do with the markets anticipating things in advance, and the buyers that are in the know already putting on their positions long before, and that's what pushed price up. So price has already factored in a certain amount of those fundamental triggers before they even come to light. And so, when you do see some of those fundamental events, except for the major seismic shift type of events, the rest of them are often in time within a few days or a week or so of market tops in this case, and we're talking about something that would impact gold bullishly. So I look at them as more of a confirmation than a lead indicator.
Eric, what sparked your interest or caught your eye about this 40-year cycle that has been happening for the last 300 years?
It's been a very steady evolution within my thinking and within my research. But also just recognizing that it has been a natural cycle for millennia, and also with being someone that's very familiar with the Bible, it's intriguing how often a 40-day and a 40-year cycle are discussed in going back to ancient times and the nation of Israel and other nations as well. And that's not the religious aspect of the discussion, but more the historical. And there are a lot of other documents and documenting information that corroborates that. So starting to see that unfold in different markets and in different geopolitical events, it just started to, the synergy of those things started to really pique my curiosity probably 10, 12 years ago, and that's when I started doing more in-depth research on it. and it's just been a steady evolution since then.
What do you believe triggers these 40-year cycles?
Well, one of the interesting things to me is that, with any of this observation of time and of time-related things, there are dozens of things in our world that we've observed before we knew the rationale behind them. And many of them we still don't know the rationale. But when you see something happen on such a consistent periodicity and sequence of events coming so consistently, after a while you just begin to say, okay, the snow comes about every 360 days or so. There must be, and it gets colder at those times. There must be some reason to this cycle. And throughout human history, you don't have to know the exact reasoning, but over time and as knowledge increases and as we do become more aware of the intricacies of this world, many of them do come to light. And one of those that I found very intriguing was in recent years when they started to look at bigger cycles within the sun and solar storms and the magnetivity of the sun. And for centuries we've already recognized that there's an approximate 11.2 year cycle of sunspots and the ebb and flow of them. And that cycle expands and contracts. I think it can get as long as 17 to 18 years between some of the peaks and some of the lows. And there's been a few instances where it's, maybe 8 or 9 years apart. But on balance, looking at 300 or so years of documented sunspot activity, it's a very consistent 11-year cycle. Then, as our technology and information and the ability to measure a lot of things became more proficient, then they recognized that there's a overlapping 22 to 22 and a half year cycle, which is two of those sunspot cycles, when the polarity of the sun actually flips during each one. And I'm not a scientist in that regard, so if I mis-explain a little bit of it, please forgive me for that. But having to do with the polarity of those solar storms and where they occur and how they occur on the sun, and so that every 22 to 22 and a half years, you're now returning to the point you were during the previous cycle. And this happens in a lot of cycle work where you have a very specific one, then you have the two multiples, the doubles of that cycle are more significant, and sometimes the triple is even more significant. But so in the sun, you've got this 11-year and 22-year. Well, then, in more recent years, they've identified what they termed the Great Conveyor Belt of the sun. And it's this oscillation within the sun, within its solar storms, within its magnetivity, that oscillates on a very consistent 40-year cycle. And they've shown, some of the impact that this has had on the Earth's relationship, the sun's relationship with the Earth. And you talk about climate, you talk about everything that has to impact our world, and also even aggressiveness, times of aggressive behavior and less aggressive behavior, or more passive behavior. And that having to do with nations, with armies, with, invading and just kind of settling in. And that the sun's impact and the geomagnetic storms that are hurled at Earth during the peak phases of this, they have a very consistent, very convincing, impact on human psychology, human behavior. One of the books I read 20 years ago by Raymond Wheeler, and Climate and the Effect on Business Cycles, and he went back using even tree ring data and lake bottom strata data going back thousands of years to show not only how climate has swung, and he documents what are basically giant, kind of like our spring, summer, fall, and winter, where you have cold, dry, cold, wet, warm, dry, warm, wet periods, and it oscillates on a 100-year basis and also on a 500-year basis. But the sun obviously being the number one factor in all of that, and they've now identified that there's a very impactful 40-year cycle. So all of a sudden it's like, okay, you have that aha moment where the 40-year cycle's been discussed for thousands of years. Now you suddenly realize that there's a major impact, a major corroborating factor of why that cycle is so predominant. And that's the case with a lot of these other cycles that, to this day, maybe scientists haven't identified the exact reasoning behind them, but they're there, they're observable, and you kind of ignore them at your own risk or your own peril.
Eric, thank you so much for chatting with us.
Thanks for having me back, Jim. Always a good time and a good conversation.
My guest has been Eric Hadik, president of InsideTrack.com, Inside spelled INSIIDE. And that wraps up our show for this week. We'd like to thank our guests Ross Clark and Eric Hadik, and thank you for listening. If you have any questions for the show, you can email us at info@howstreet.com. I'm Jim Goddard. We're back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at talkdigitalnetwork.com. This Week in Money is a production of How Street Media Incorporated. Executive producer is Tom Allen.